Okay, so like I said, I'm gonna record this, so it's gonna help also many people having trouble with the book, understanding the hedging process, which I understand the fact that it's not something common that we are used to trade with. So we have to agree with a few things here that using stop loss is really not an option when you trade the FX market or when you trade with high volatility markets. Do you agree?
Okay. Yes.
Yeah. Okay. We have to also agree that the market today is all over the place. So you have to get ready for different scenarios, even though you have a clear strategy where the euro is going or the pound is going, right? So we have to get ready for crisis, every time. Okay. And hedge funds are made for this. Hedge funds are made for with the option that when you trade and for example, you want to go long for gold, long for euro or the pound or long for the dollar, many things can happen. So the crisis comes, one day to another, like the war in Ukraine and Russia, like the pandemic, like many things, and many other things are going to happen. So that's why the hedge funds were created, because even though you have a clear situation of interest rates and central banks and everything, many things can happen on the way, so you have to get ready for all sorts of scenarios. And that is the concept of hedging. That is the concept of hedge your portfolio. Basically, you know what to do, but then at the same time, you have to get ready for everything else. And that is going to help you to get your trades in your trading accounts in balance and hedged out. And I opened this demo so we can do some experiments. This is my real trading account right here. And this is a demo so I can show you now, because we have information coming up in 1 hour, which is inflation of the US. So let me explain really quick how it works. So now, for example, you know that today the strategy is based on, it's kind of sideways, the market, but at this moment, the dollar is down, the euro is trying to go up, the pound is trying to go up. So we are into a very important moment today, since depending on inflation information, the market is going to do crazy stuff today, because we know how inflation works with the Fed. Do you agree?
Yeah.
You know what it means, right? Like higher inflation, it means that the dollar is going to go up, because the Fed is going to get more aggressive with rates. If inflation goes down, the market is going to withdraw from the dollar, because the Fed is going to assume that the rates are no longer needed to be as high, and they can start doing the opposite process. So inflation is everything. We do not wait until rates decision, because we know the market is going to discount that. We're going to assume beforehand. So let's say that you have a clear strategy. For example, you're going to go short on dollar Canadian below 137. You want to go long on the euro, for example, today above the 107.20. So you start setting up your trades. You put up your chart lines. I only use chart lines. I say, okay, I'm gonna buy here, I'm gonna close here, I'm gonna buy over here, and I'm gonna close it over here. So that's all I do. I place the map price and then the ranges that I'm going to be opening and closing trades on that specific market intervals. Okay. So now you have your line set up, you know what to do today, up to the highest, the lowest, people points, you know what to do. Now, the thing is, when you are in the market already, let's say, for example, I'm going to open buy on the euro right now. So I say, okay, I have the euro today above the central pivot point. I am above the 107. I know the euro is going up. The European market opened for buyers on the euro, so I'm expecting the euro to keep pushing higher. That's what I see. This is European hour London this European opening hours right here. And what they did, they pushed the euro up. So at this point, I have the euro above 107. I'm above the pivot point. So everything is telling me just go long on the euro today. So let's say I have a confirmation. I can just go ahead and buy the euro dollar right now, even though I wouldn't do it because, like I say, I have inflation coming up. So I will wait to get closer to the information before I do it. And that's what people trade with me. And, you know, they see my trades and they copy my trades while they understand what they're doing. It's not just a copy trade. I'm live like this with you. And that's what we know, what all we do from Monday to Fridays. Okay, so I'm going to buy the euro. I'm going to accept the disclaimer. It's very important the broker that you use because not all of them allow you to hedge. Not all of them allow you to hedge. And also on the hedging process, you must have a regulated broker. Otherwise, it's really complicated because they had to respect everything on margin levels, on the spread situation. If something is missing in the process of the in your broker and they change something, then the hedging it might not work. So you must be under an FCA regulated broker. I use One Financial Markets. Everybody knows that. I've been here for 15 years and never a problem. Okay, so I just bought the euro dollar. Everything is on the way. My target, which I'm going to close the trade, is over here. I want a 730. You know, I do not use take profit. I do not use stop loss or anything like that. I open my trade and that's it. Now, every time, since I don't use stop loss, every time I enter the market, I need to know what to do if something opposite happens. Okay, so I know that everything above the 107 on euro is a long strategy, is for the buyer. I had to decide then how am I gonna scalp the area, which I know the market intervals, like I said, 107 to 107.10, 107.10 to 107.20, 107.20 to 107.30, up to the high of 107.50, and that's it. That's the highest I can go scalping. After the 107.50, I know that I need a confirmation before I buy because that's the highest and that's a very important level where the market might take their profits and the euro may go down. So this is how the beauty of hedging works. Let's say that, you know, you have the buy, everything goes fine, and something happens suddenly in the market and the euro starts just dropping, going down. So I said, okay, as long as I'm above 107, I can tolerate the fluctuation of the price since it's fine, you know, it's not going to be a straight line up to the targets. It might be a fluctuation. But as long as I'm above 107, my strategy is not going to change. So I have to be clear on that. Above 107, all buyers. But I opened the trade at the 107.20 almost. So yes, it can go down to 107 before it goes to my target. No problem with that. The problem is when the market gets below 107, I'm going to start to be kind of aware that a reversal may happen and the market may go down from the 107. Okay, so what I'm going to do here, I'm going to put a line, set up a line at the 107 right here, and then I say, okay, that's my limit. Below 107, I'm going to start shorting the euro. I'm going to hedge my long position. I'm going to protect myself. So let me see what happens here. You have the margin that you're using is $107 from your total balance of 10,000, which is a very low risk. So I'm free, you know, almost 9,000, margin level is good, everything looks fine. So what happens when the market goes against you? You know that the margin level is going to start dropping, your margin requirements is going to be more aggressive, the margin that you're using is not going to change because it's the same. So this is the margin that I'm using from my balance. And if I open a sale right now, it is going to disappear. The margin, the free margin, and the margin level because I'm hedged. So until I don't know what direction the market is going to take because it's below 107 at this point, I'm going to be hedged. So let me show you what's going to happen next. Pay attention down here, the balance, the equity, the free margin, margin level. So I'm gonna sell. And boom, what just happened? Then you have everything free again. The equity, margin, the free margin, and your balance, everything is equal because you just hedge your trade. You have all 10 on buy, all 10 on sell, and the broker is confused. It's like, then you don't have anything open, they're gonna say. And you're like, nope, I'm hedged, so I'm using the same amount of buy to short because I don't know what direction the market is taking. So I'd rather protect myself before anything really bad happens. So
Yeah, that is where everything gets complicated.
yeah, we're gonna start from that point. So you know what to do in terms of hedging, right? You have the buy, you have the sell. The broker is like, okay, I'm not going to touch you. I'm not going to get you any drawdown because you're hedging. You're betting the same amount on your buy as the same amount on your sell. You're hedged out. So now, let's say that now the market gets a direction. So I know that it's really going up instead of down. I can hold the sell, I can hold the hedge, no problem. And then I can be just doing my scalping with the buy and just buying up to the highest level that I set, up to I'm done with the buy. And then I'm gonna look for the sell right here. So I'm gonna take my profits on the euro. And then what happens? The same the same before, except now that I have $3 and positive in my balance. But then the margin requirements is 107 again. Free margin is moving, like a margin level is also pushing. But now I have the sell in the market and I do not have a buy, right? So I need to do something because it keeps pushing up and I say, I took my profits on the buy, but I have the sell in the market. So I have to keep hedging now the sell because you change your strategy. I'm giving this example, but this full process happens in a week, maybe in 2 weeks, that the market gives a really turn, that you go long and you go short and you start hedging the process, So I'm going to buy again. And again, one more time, you have equity, free margin, all locked up. You don't have margin requirements, like you don't have the margin moving up and down. You don't have the margin used, like I show you on the first number, moving up or down. The broker is like, okay, I'm not gonna touch you. I can't touch you. I can't close your account. I can't give you any, stop out. I can't do anything because you're hedged. The problem of hedging comes when you either take decisions before you should. For example, the euro is going to go up to the high of 107.50, and then I'm going to go short. I'm going to look for the sale. What if the euro, instead of going down from the high that I'm expecting the buy to go, it keeps pushing even farther, and it goes to 108. Now the sale is going to get a more drawdown. And that is sometimes the problem, that you had to be really quick because that sale transaction that you have at the 107.20, if the price is once at the 108, the drawdown is too high. So you had to start taking decisions. And what I highly suggest is that you start taking small losses from that opposite trade that you have, and then once you basically take the entire loss. Once it's done. Like, I start taking small losses until the sale is over. I don't have any more sales on my trading account, and I only go long. Okay, so step number 1, you know what to do. Step number 2, you know the limits, like below 107 what to do. So I'm going to be shorting below 107. You had to know your parameters. Once you're done with the hedging, you know that it's not going to go down anymore, and then you go for the buy, then you're going to do fine. Okay, but there's going to be a point where the market, it is going to take direction, a projection. At this point, we are into the sellers. 100% euro is a short strategy because we are below 110. If you have on the book, which I highly appreciate your suggestions, and I'm going to change that. This is the Spanish version on the book. And like I said, the hedging process, I know it is confusing because you know what to do, but then up to what point? You know, so if you have a sale at the 107.20 and the market goes above 108, what are you going to do with the sale? You must start taking small losses until you don't have any more sales in your trading account, because it's going to push your margin requirements once the price keeps moving higher and higher and higher. If I have a sale on the euro, that's fine. I know it's going to come down anyway. Okay, so again, I'm going to close the buy transaction right now. I took the profits, and then what happens? Again, I have margin level full margin level, margin requirements 107.20, free margin, again this amount, everything looks fine. But look at the sale. I have almost $6 negative on my short, because that's the one that I'm using to hedge, you know. So okay, that's fine. I know that it's going to go down from whatever high it goes today, or with inflation or whatever. Okay, and I keep doing that same process, you know. It keeps moving up and I keep buying, keeps moving, I keep buying. I take the profits. So when, up to when I take the profits, that's also a question that you might have. And let me see, how can I open here? So, because everything must have a parameter. You cannot do this forever and keeps moving up and the sell still there. A certain point, you must know what to do when the market turns around or it goes higher, and you have still a short strategy in your trading account. So let me show you what to do here. And I always suggest you write down first what you're gonna do, and then you apply it, okay? So this is the situation. This is the 107, and I know I go long above 107. I know I go short below 107. So I have a buy here. I know I have to short below 107, which is I have to hedge, okay? So let's say I go to hedge and the sale is there, like the hedging is active, but then it went up again. So I started buying and buying and buying and buying up to what high? Well, 107.50 is fine, you know. Below 107.50, I know I'm gonna go look for my sale transaction, and I'm gonna close it even positive, which is at the 107.20, because it's gonna go down from here. This is the plan A and the highly probable situation. You know, remember that on price action, over 85% of your trades are positive. If you're doing right, above 85%, your trades are going to be positive. So now it's going to go down to here, and then that's it. Plan B, which anything can happen in the open market, you know, plan B. So if the market gets above the 107.50, I'm going to keep hedging the hedge. Like I have the sale now, and my entire process, if it is above the 107.50, I must be able to keep buying because I still have the sale. So let's say I have 110 here as the sell transaction at the 107.20. So what I'm going to do, I'm going to be more aggressive, hedging the hedge now. So I have the sale here, and then I'm going to start buying 0.20. I'm going to double the bet in the buy since I have the sell, because I have to make more profits now, trying to take small losses from the sale on my trading account. So I have 0.20, and I'm going to buy above the 107.50, you know, just keep buying up to what levels? Well, depending on the day, but I know the levels: 107.60, 107.70, 107.80, you know, up to what? Yes, it could be up to 108. I know that. At this point, or once the market is above the 107.50, I'm going to start taking small losses. Let's take $1 at the time. For every 10 pips, the market goes up against my previous transaction. Because I'm going to keep making money anyway. I'm going to keep, buying in the process.
What happened if it goes back to the sell?
It will go back to the sell. It goes back to the sell, then you're just going to go for the sell and take your profits. And of course, you're going to be shorting anyway. So what you're going to do is this. We are, let's say, once we get below 107.50, you're going to start shorting again at 107.40, down to 107.30, down to 107.20, and then you're break even. You are at the point where you started it, the first hedge, the sell. That's it. And then you keep shorting down to 107, below 107, keep shorting, and you keep doing the process. Okay, so of course, this requires first planification. You know what to do on every scenario. Optimal scenario. You go, you know what to do, you have the prices, you know the intervals, the scalping you want to take, but always have a plan B. And that's when the people get sometimes stuck because, like I said, the Fed is changing every time. Lagarde talks and she says whatever, and something happens. So you must have a plan when things go not exactly as we plan on price action, which at this point is when the market is expired. The sell situation, and it goes even farther, 108, about 108, 108.50, about 108.50, 109. And yet the euro, it is into sellers. It is into sales strategy, okay? Everything below 110, you must consider that the market may go crash anytime. It's not strong. The euro below 110, people, Europeans, the entire market is not betting as long-term situation, long-term transactions, or a bull projection on the euro. Everything below 110, if you have a buy situation, a buy day, you had to take it slow. You had to kind of like, I don't trust this too much. I know something's going to happen anytime. You know what I mean? Only about 110 on euro, we say, okay, I can relax now. Everything's fine. We're going to 111, 112, 113, 114. Okay, so that's what people many times don't understand. They think that it's going to go up forever. If it goes up 1 day, 2 days, 3 days, it's going to go up forever. But price action show us statistically that below 110, get ready for the crash. Something's going to happen. Okay. But like I said, the most important things here is how you manage your strategies, so you know what to do. You have, you're gonna go, you had to have the tolerance. That's what people sometimes get a little bit confused, because we buy on the euro, right? And then something happens and it goes down to 107.10, 107. And I say, that's fine. Let's just give it a time. As long as we are above 107, the market is going to take some time before it goes to your target. It's not straight lines, but when you don't use stop loss, you kind of get nervous. People cannot tolerate to see $100 against you, or $200, or I don't know. Some people just get really nervous about it. I can tolerate to see $1,000, $2,000 against my trade because I'm aggressive in terms of the lots that I use, and then I hedge that sale or that buy, and then I go look for it. I know it's gonna go up. That's up to a certain point, and then the hedge I have active down here, I'm gonna go look for it. If it gets messy one day and I'm buying, and then it's not going to any target, goes down really quickly for whatever reason, I hedge. I'm done with the hedging. I go look for my buy, or the opposite, depending on what trade, on what currency I'm involved. Okay. But again, many people have, the strength to just hedge and go against your own trade. Some people don't. So it's really some exercise that you must be consistent. Like I said, the only thing it's doing is protecting you. Okay, so I have the sell here, And I'm gonna keep buying. I'm just gonna keep buying. Okay, it's not going down. I'm gonna keep pushing. I'm gonna keep buying. I know that I'm above 107, above 110.20. I'm gonna go up to 107.31 or 740. Okay. And then at a certain point, there's no more hedging to do. Like I said, over here on euro dollar at the 107.50, I must respect that as the highest and the possible price where the market is going to go down again. But in the back of my mind, I must also have the plan B, which is about 107.50. I'm going to be even more aggressive sketching with the buy. I'm going to make even more profit so I can get out from that sale transaction as fast as possible. So once I know, you know how to close a partial trade, right? For example, you have this sale at the 107.20, the market is already at the 108. So I'm fine with the loss. I'm just not gonna keep it too long, you know? So I'm gonna right click on it. I'm going to modify and I'm going to go for market execution and I'm gonna take a small loss. Let's say 0.02, just a little loss. And I'm gonna close that amount. So what I see here is that, okay, I'm starting to reduce the amount of my sale transaction because I had 110, I have 108 now. So when the market keeps moving up, I'm also going along with that, taking small losses. So at a certain point, I'm just gonna take all the entire loss altogether while I'm making money hedging the transaction. So it's basically just going with the flow, taking the losses on the expired transactions, going back to the levels that you want to go trade, you know, just taking step by step, but doing something with the sale that is no longer sale. You know, so that's what I always suggest. You must start taking little losses, you know. So in your account history, once you check it, you're okay, you're making more profits than losses. That will always be the case when you hedge, always. When you have expired transaction, when you are, for example, shorting the euro, but suddenly you have a buy date, 2 days on the road that is going up. I'm going to take some losses on the sale. I don't want to hold it for too long. I don't want to see, I don't know, $3,000 a negative. So I'm going to take the small losses. The sooner you do that, the better. You don't have to take the entire loss at once, because I'm also using that to hedge against that trade. So I make more money with that process. And let me show you why. When I say go double, when I'm above the 107, this is what I'm trying to say. So I have the, let's say I'm going to go for the buy. Let's give the example that I'm going to go long on euro, but then it's going down. So I had to be really quick making more money on sell transactions so I can get rid of the buy as soon as possible. So let me show you what happens here. I'm going to close the sell here. I'm back to the 110. Okay, I'm back to the 110. So the broker is considering that I'm using $107, 110. If I open a sale, a short of 010, I'm overlapping the trade. It's like I'm blocking, I'm hedging. But what if I use 020? You may think the broker is going to take you 030 from every trade that you do. So 100, 100, and 100. But that's not going to happen. That's not the case. So I'm going to open 020. I'm going to get more aggressive, shorting the euro because I have the buy, and now it's going down. So I'm going to make 020. And let me show you what happens. Pay attention on the margin. You have 107. And now when you short with double lot on the sell you have, I'm going to now, I'm going to short, I'm sorry. Yeah, I'm going to short 020. So look, I'm using the same. I'm not using 030. I'm not using 010. I'm just using the same. You see, I'm using the 107. And you may see how that happened, because you're hedging the 110 and you're only using 110 again. So the broker doesn't know the difference. That's a really nice trick. They don't know the difference. When you add a lot or when you hedge part of the trade and you add a new lot, like all 10 in this case. You follow me? So up to just before, we were hedging the same, okay? 10 and 10, 20, 20, 30, 30, depending on the lots that you open, always hedging on the same. Now what I'm showing you is that you can hedge using more lots, and the broker is gonna still hedge you on the same amount, and they're gonna take from you only and only thing the lots that you're using as the difference. So what's the difference between 110, 010 and 020? 010. So the broker says, oh, okay, so you're trading with 010. No, I'm not. I'm trading with 030 in total, but I'm hedging just 010. And the difference, I'm on the open market. So the margin did not change. And I'm shorting 020 because now I had to be really fast. I'm making more money. Shorting the euro so I can make more profits because I know it's going to go down. So my strategy was okay. But now I had the buy above me at the 1.7 something. So I must be really quick shorting with more lots so I can take the losses really quickly. You know, like I show you, 02, 02, 02 until I don't have any more buy. And that's it. I'm showing you this process, like I said, takes a week, maybe 2 weeks, but this is kind of fast so I can explain you everything. And we don't hedge as fast as I'm showing you now, of course, you know, like I show you, you know, you buy the euro 107.10 or you buy the euro 107.20, you're not going to hedge as fast. The only hedging process is only below 107. And you know what? It can just go down to 106.80 and that's it. And then going back to the buy transaction. So you don't rush yourself to hedge. You give the market some time.
Do you wait for it to close before?
You wait for what?
Do you wait for it to close below the last interval?
Yes. You wait until you close below it. Yes. So you're on 15 minutes time frame, and then I see the market already in the 15 minutes closing below the 107. And then I'm saying, okay, I'm just going to short for fun. I'm going to short down to 106.90. And then it keeps dropping. Okay, just for fun. I'm going to go another sell down to 106.80. And then did not go down anymore. Okay, then I'm going to back to my 107, 107.10, 107.20, 107.30. The same as the high, you know? Okay, it's gonna go to 107.50. I'm okay having my sell transaction on the 107, 106.80, for example. And I'm okay at 107.50, no problem. And then it confirms about 107.50. I'm gonna start buying more aggressively, you know. So I have the 10, the all 10 here on the sell. I'm gonna be buying very more aggressively, all 20. Confirmed above the 107.50, I'm going to be buying 020, 020, 020, 20 up to 108. In the meantime, I'm going to be reducing like 0.2, 0.2, 0.2 every time the market goes up. So I'm going to be reducing the drawdown on my sell transaction. Okay. So like I said, this is the most amazing process on the entire world of trading. There's nothing like hedging and doing things smoothly like this, planning the scenarios, knowing when to go more aggressive, knowing what to do with the expired transaction, not to wait too long, okay? And just go with the flow. That's all we're doing because, you know, it's a $3 trillion markets, open markets every single day. And we are trading with what? I don't know, $2,000, $5,000, $10,000. So you have to know what you're doing, you know? You cannot just wait until market goes back to your, you know, your strategy because anything can happen. As long as you have a plan, you're going to do fine. You can just be doing this forever, you know, and just keep being positive every single month, you know. Of course, you have to, like I said, to trust the broker that you're with, because they must respect the margin levels. They must respect the everything, you know. If they change a thing, it can screw you, you know, because like as we're hedging, so if they change the market requirements and one day you have all 20 as requirements or $100 and then you have 150, that can change your hedging process. And you know, they can do it if they're not regulated. And I've been through that. That's what I'm saying. I lost even knowing what I was doing. I lost in brokers that they were not regulated. So I keep insisting, just go with FSA, go with FSA. We trade with hedging. Some brokers, they don't respect hedging because they don't know it. And they think people don't know it. And once you do, and you're a professional trader doing this, you know what they're doing. They're just manipulating your prices, your hedging, your margin, and everything. Okay?
Do you ever wait with a pending hedge as a protection? Do you ever wait with a pending order for hedging as a protection?
Yeah. I do. I do. I deactivate the hedging on opening on the opening moments, on the first 15 to 20 minutes opening hour, on the 15-20 minutes on the closing hours, and when you have data, because the spread, you don't want the spread to activate the hedge. Okay. So, okay, I'm going to close the buy here, and then I'm going to go for the sell. Because you see what happens just now. It's testing the 107.30. So I do not trust the 107.30 for buyers. It's only kind of testing. If it touches the 107.30, I may go buy and hedge the sell that I have. Otherwise, it's going to go down anytime soon, but I have to get ready for the possible buy, and I'm going to do it when I see it. I'm not going to have a buy stop there. I do not want an activation if I know that it's a high. You know what I mean? That's very important. It's only a high. So it's going to go test it. You don't want to have a buy stop exactly there. If I have a buy stop, it's going to be a 107.40 maybe, 107.35, but not at the 107.30, you know? Because activations with the spread might happen, and on the open market, when you have a kind of crazy spread because information coming up, you don't want to risk that situation. So you may want to either put it way above, like 5 pips of difference with your price, or even 10, and then if anything, just move it, but not having exactly at the high. The market goes and tests highs every time. You don't want to hedge there. You want to hedge when you have to hedge, when you know there is no other option but just to go the opposite way. It's not going down anymore. It's going up now. So that's when you start moving things around. You say, okay, I want to keep buying, but just the buy stop, the sell stop too close, because that's what you're thinking with fear. When you think and trade with fear, you're auto-sabotaging yourself every single time. I don't care if it goes up. That's fine. If I had to buy, I'll go buy. I don't even need a buy stop anymore. I know what to do. But if I'm afraid, I'm not sure what I'm doing, or I'm scared it's going to turn around, or whatever, I can guarantee you, you're going to put the buy stop exactly when the market is going to go down again, or the opposite, depending on the case. You know that. So always remember, do not make any decisions upon fear. Always with a plan, with a strategy, knowing, okay, from the, you know, not from fear, because fear is gonna, like I said, it's gonna make you lose. Not today, maybe tomorrow, but that's the thing. Exactly at that point is going down. Exactly at that point is gonna turn around. You know that it is exactly like that. Okay, right, I got to go now. We have information coming up, and that is inflation. So please be safe trading that if you're gonna trade that. And I'm gonna finish the recording now, so I can